Hi, Michelle Strickland here with Melior Consulting. So I get questions about employees who work at tech companies or any company where they're receiving equity compensation. So examples of that are restricted stocks, RSUs. That's going to be the most common, especially for like your average employee. Executives are going to have performance share units and options and cool stuff like that. But yeah, if you're an employee and you have restricted stock, just be aware, you want to meet the holding period. So once your RSU is issued to you, there's typically a holding period, right? In order for you have to vest, and there's always a vesting schedule, and it depends on your company. The next is a holding period. So if you want long-term capital gain treatment, you're going to want to hold the stock, for at least a year. And if you sell it as soon as you get it, that's going to be short term, and that's going to be ordinary tax rates. But the next factor, once you have RSUs and you meet the long-term holding period, so you can get your long-term capital gain treatment, is don't just sell all of it in 1 year, because you're going to owe tax on the difference between the amount that it vested and the price at which you sold it. So, say you work for Nvidia, right? And their stock went bananas. If you sell all of that stock, you're going to have a big hefty tax bill. So don't sell all of the stock. Do it in, they call it tranches, kind of like different buckets. Work with your CPA so you can take that into account in your estimates. And if you plan on selling through the year, just keep track of it, because, that capital gains tax will add up. But you want to track, the basis that you have, right? The value that it was when it was issued to you and when it vested, and then the basis when you sell versus the sales price, the stock price when it sells. The difference is going to be your gain. So that gain is something you want to just keep track of, and you're going to owe capital gains tax on that. On your RSUs, maybe you want to sell them off kind of in a more planned cadence. That's a great option, right, to do that versus like a fire sale, right? Just, hey, let's sell it. We need some cash. We're gonna go on vacation. So work with your CPA, plan it out. And that's a great model for kind of how to address your RSUs. If you don't need the cash, just hold on to it. But make sure, look at your portfolio. And when you work with your financial advisor, they're going to suggest that your portfolio is not like 50% in your company stock. So as you get more RSUs, as they vest and they come into your portfolio, review your situation and see what percentage your company stock is out of your whole portfolio. If you plan on selling, just be aware of, right, you want to have that long-term treatment. Work with your CPA to estimate what that capital gains tax will be. You don't want to get a surprise bill. Oh my gosh, I owe $10,000 because I sold a whole bunch of company stock in the year, thinking it's like a freebie benefit from your company. So those are all my suggestions and tips. A lot of it hard earned, learned personally. And so that's what I wanted to share with you.